I'm going to be speaking about a little bit more about the corporate tax rate, international tax reform, and then I'd like to talk a little bit about financial reporting and how this would impact financial statements for 12/31/17. So I've got to move through this rather quickly as we're getting close to the end. Under the House bill, the corporate rate is going to be reduced, as we know, from 35% to 20%, and the corporate AMT rate will be repealed effective 1/1/18. The Senate bill, same rates. However, the reduction in rate will be effective 1/1/19 at this point in time, and the corporate AMT rate would be the corporate AMT will be retained in its current form. So the corporate rate and the AMT repeal will be reconciled in committee. From what I'm hearing, the corporate rate is likely to move to 22%, which should give the committee enough money to make the rate change effective 1/1/18 and repeal the corporate AMT rate. So this is something that I'm hearing now, so we just have to stay tuned on that. I wanted to mention the dividend received deduction. The amount of the deduction allowable against dividends received from a domestic corporation would be reduced to correlate with the reduction in the corporate rate. So specifically, the deduction for dividends received from other than certain businesses, small businesses, or those treated as qualifying dividends would be reduced from 70% to 50%, and dividends received from 20% owned corporations would be reduced from 80% to 65%. So if the corporate rate moves to 22%, then those dividend received deduction will be changed proportionately. So before I get into the international tax reform, I would like to provide some color to the current international tax system, how it is now. So how does the current system of international taxation work? All countries tax income earned by multinational corporations within their borders. The U.S. also taxes the foreign source income of U.S.-based multinationals when it is repatriated to the U.S. parent, for the credit for foreign income taxes paid. Most other countries simply exempt the foreign source income of their multinationals, often referred to as a territorial tax system. So how does the U.S. currently tax foreign source income? We should be, we're good. This actually is not a slide. The federal government taxes U.S. resident multinational firms on their worldwide income at the same rates applied to domestic firms, which is up to 35%. So U.S. multinationals may claim a credit for taxes paid to foreign governments on income earned abroad, but only up to their U.S. tax liability on that income. So U.S. multinationals generally pay tax on the income of their foreign subsidiaries only when they repatriate the income, which is referred to as a deferral system. Deferral and the credit limitations provide strong incentives for companies to shift income from the United States and other high-tax countries to low-tax countries. The U.S. has rules in place intended to limit the ability of their resident corporations to shift profits to low-income countries. These rules, referred to as Subpart F, tax some forms of income, typically passive income, such as interest and dividends on a current basis. So under the current tax law, Congressional Budget Office projects that corporate revenues will decline about 1.5% of GDP at the end of the next decade due to continued shifting of reported profits overseas, increases in the share of business activity originating in partnerships and corporations, and the permanent extension of some corporate tax incentives. So let's note, U.S. corporate tax revenues lag behind other developed countries because of a narrow tax base. An increasing share of business activity originating in businesses not subject to corporate tax, and increased incentives and opportunities for U.S. companies, especially with those with significant assets in intangible property, to shift the property abroad. So international tax reform is being proposed to incentivize U.S. multinational corporations to bring back foreign earnings, do more business in the U.S., creating more jobs and higher wages. So now let's discuss the many provisions that could impact U.S. corporations. Not yet. The U.S. is trying to move to a territorial system, but as Amanda stated earlier, it doesn't seem to be getting that way. They're trying to move away from the deferral system, so let's see what happens. So what's in the proposed law? So let's begin with the 100% exemption for foreign source dividends. The Senate bill, similar to the House bill, will exempt 100% of the foreign source portion of dividends received by a U.S. corporation from a foreign corporation in which the U.S. corporation owns at least a 10% stake. The effective date for the proposal is a foreign corporation's tax year beginning after December 31st, 2017. Okay, now we have that. So let's talk about the transition tax on deemed repatriation of foreign earnings. It's a one-time mandatory transition tax on accumulated foreign earnings wherein U.S. shareholders owning at least 10% of a foreign subsidiary would include in income their pro rata share of the post-1986 E&P. So there's a couple dates in the House bill and the Senate bill where you would measure that accumulated earnings and profits. House bill November 2nd and December 31st of 17, whichever the E&P amount is greater. And the Senate test date is November 9th or some other date yet to be determined. So once you determine what your accumulated earnings and profits are from 1986 forward that have not been taxed, those earnings that are held in cash and cash equivalents would have an effective tax rate in the Senate bill of 14.5% and in the House bill 14%. All the other earnings that are not cash equivalents, these non-liquid assets, would be taxed in the Senate bill at 7.5% and the House bill at 7%. Now, obviously, these are going to be reconciled in committee. So the foreign income will be reported on the company's last tax year beginning for 2018. If, for example, a company is reporting for a calendar year foreign corporation, then the 2017 tax return will report the untaxed post-1986 accumulated E&P in income. To ease the tax burden, the taxpayer can elect to pay the tax over an 8-year period, which is in both bills. However, under the House bill, the income would be includable in taxable income ratably over an 8-year period, which is 12.5% per year. The Senate has some other variations in there. So what do you have to do? It's imperative that any 10% shareholder of a CFC, which is a controlled foreign corporation, review their E&P calculations to determine their accuracy at this time. This amount will be subject to tax, and if needed, SC&H can certainly provide assistance with that calculation. So the last polling question is, do you think the tax reform bill will be signed before Christmas 2017? Okay. So there's no correct answer to this question, but we had 69% say yes. So let's hope so. So the next slide I want to talk about is now that accumulated earnings up through 2017 have been taxed, the next step is how do you tax the earnings going forward each year? And so there's what we call anti-deferral rules, and the House has this acronym FHRA, which equals foreign high returns, and the Senate has one defined as GILTI, global intangible low tax income. Now, I can hear all of you out there laughing at this point in time. because you got to wonder who comes up with this stuff other than Congress. So Congress is taxing current foreign earnings for tax years after 2017 under this. Most existing Subpart F provisions are retained. The new rule, both bills contain a provision to impose tax based on a normalized return of tangible assets based on a complex formula. The House bill imposes a tax on a net basis, while the Senate bill is a gross basis tax less a 50% deduction. Now, you are allowed foreign tax credits up to 80% against this tax. So this provision is designed to tax excess current year foreign earnings, like a minimum tax, on the combined income of foreign corporations above a normalized return on tangible depreciable business assets. Profits in excess of what is considered to be a normal return on assets are essentially considered to be attributable to intellectual property, IP. The intention is to impose tax on multinationals who have offshored their IP and to incentivize companies to domesticate such. A separate provision provides an incentive to companies willing to bring back IP to the U.S. by eliminating any potential tax due to an offset in the stock basis. Usually a distribution from a corporation will result in U.S. tax in the form of a dividend, gain, or other, which is being eliminated if the IP is brought back within 3 years, and this is still pending. As stated in comments to the provision, the rules for implementing this proposal will be complex. Let's go to the next slide. I know that it's 2 o'clock. I have a few more slides. Hopefully folks can stay with us for a little bit here. So the House and the Senate have put forth provisions to provide for excise taxes really on payments to related parties, or related foreign parties. So the House version is an excise tax. And so they're imposing an excise tax on certain payments from domestic corporations related to foreign corporations where payments other than interest made by a U.S. corporation to a related foreign corporation that are deductible in the U.S. will be subject to a 20% excise tax, unless the related foreign corporation elects to treat the payments as income effectively connected with the conduct of a U.S. trade or business. So that means they'd have to file here in the U.S. A foreign corporation that elects to treat the payments as effectively connected income would reduce the payment by deemed expenses allocable to the payment. The provision would apply to international financial reporting groups with respect to years after 2018, and that have an average annual aggregate amount of specified payments exceeding $100 million over a 3-year period. The Senate version, referred to as BEAT, Base Erosion and Anti-Abuse Minimum Tax, imposes a 10% tax on deductible foreign payments from a U.S. corporation or corporations with substantial gross receipts. This provision will require U.S. corporate taxpayers with annual gross receipts in excess of $500 million averaged over 3 years, and certain deductible foreign-related party payments to pay additional corporate tax in certain circumstances. The base erosion minimum tax will be imposed if 10% of the modified taxable income, generally defined as taxable income plus certain deductible foreign-related party payments of the U.S. corporation, exceeds the U.S. corporation's regular tax liability for the year as determined with certain adjustments. Hence, this is where we talk about this is kind of a minimum tax. The proposal would apply to base erosion payments paid or accrued in taxable years beginning in 2018. So in layman's terms, if this can be put in layman's terms, you have taxpayers with average annual gross receipts of at least $500 million, so they're large corporations, averaged over 3 years, who are not regulated investment companies, REITs or sub-S corps. They're not subject to the tax. Those companies are subject to the tax if, in addition to being a large multinational, at least 4% of the company's deductions are the result of payments to foreign affiliates. The goal is to get large multinationals that make payments to foreign affiliates, resulting in deductions on its U.S. tax return equal to 4% or more of their total deductions, to pay more in taxes. Note, U.S. corporations with foreign related party payments of less than 4% of their total expenses would not be subject to the tax. So the Senate bill is widely expected to survive in the conference committee. Taxpayers, as defined in the provision, should evaluate their exposure to the base erosion minimum tax. As with most of these international tax reform provisions, complex calculations may be required on an annual basis for taxpayers that could be subject to the rules. Companies may want to consider repatriating intangibles that were previously offshored to avoid this tax. I want to touch a little bit on the, do I have a slide on the interest? Yes. I want to touch a little bit on the interest deduction limitation. Angelo and Justin spoke about this earlier. So you have the 30% of adjusted taxable income, but there's another layer to this. So domestic corporations that are members of an international financial reporting group are subject to an additional limitation on interest. Interest expense of a U.S. corporation that is a member of such a group will be limited to the extent of the U.S. corporation's share of the group's global net interest expense, exceeding 110% of the U.S. corporation's share of the group's global earnings before interest, taxes, depreciation, and amortization, EBITDA in the House version. The Senate version is similar, but it's EBIT, and we had a discussion about that earlier. The provision would be effective for tax years beginning after 2017. So, as with the House bill, when both the Section 163J and the worldwide interest limitations apply, the one that results in the lower limitation on interest deduction, and therefore the greatest amount of interest to be carried forward, will apply. And there is a carry forward situation here for limitation on the interest. The Senate bill allows disallowed interest to be carried forward indefinitely, as opposed to a 5-year carry forward proposed in the House bill. So let me go to my last slide here. And this is on Accounting Standard 740, considerations given to accounting for income taxes. So when you lower the corporate income tax rate, you will have an immediate impact in the period of enactment. So under ASC 740, these are the folks that are worried about tax provisions and financial statements. The impact of a change in the tax rate on deferred tax assets and liabilities, along with their valuation allowance, is recognized as a discrete item in the period of enactment. A lower corporate income tax rate will require the future benefits of existing deductible temporary differences and carry forwards, such as accruals for pension liabilities and net operating loss carry forwards, and the future cost of taxable temporary differences to be remeasured at the rate at which they are expected to reverse in the future. So that's important because those that have deferred tax assets on the books right now, going from a 35% rate to a 20% rate, will record additional tax expense in the year that, or period that, the president signs the bill. So it's a really big deal for those companies with deferred tax assets. On the flip side, if you have a deferred tax liability, you're going to record a benefit. So if the law is signed by the president in 17, the remeasurement will be reported on the December 31, 2017 financial statements. If you're a fiscal year taxpayer or a fiscal year financial statement filer, you would have a quarterly filing due, and that would be a discrete item in that quarter. So just wanted to mention that although we think that the Senate and House will come to the same reduction in tax rate, and hopefully it comes together in effective 2018. Under the current proposals, the House's reduction in rate would be 2018. The Senate would be 2019. If that does hold, and that's the case, it goes to, let's say it goes to 2019, the rate reduction, then what's going to happen in the financial statements? So the rate reduction currently applies to years beginning after 2018 in the Senate proposal. Companies will need to determine how much of the temporary differences will reverse in years beginning before January 1, 19, and continue applying the 35% corporate tax rate to those amounts. Companies should consider the information they will need to determine the amounts of temporary differences that are expected to reverse before the period in which the new lower rate applies if the Senate version is enacted. The scheduling of temporary differences will, excuse me.
The scheduling of temporary differences will take additional time and could significantly impact the tax effect recorded in the period. And my voice is gone. And that's the end of the presentation.